Welcome to a deep dive. Today we are tearing into the Q4 and full year fiscal 2025 earnings call for Limoneira.
And really, you can just throw the recent results out the window. This call was all about one thing.
What it was?
A massive, and I mean massive, business model pivot. Management basically said fiscal 25 was the year we paid the bill for future growth.
Right. So our mission today is to figure out if that bill was worth paying. We're looking at everything, the cost cutting, the big shift from lemons to avocados, and this really aggressive plan to sell off assets.
The question is there real substance here?
Yeah.
Or is it just a good story?
Okay, let's kick off with the results because the numbers were, well, they were all over the place.
They really were.
The top line, the revenue, was actually a beat. It came in at $42.8 million versus a consensus of about $38 million.
Yeah, which was strong. I mean, it was down a little bit year over year, but the market was expecting so much worse.
But then you get to profitability, and that's where the story just completely flips.
Oh, it was a bloodbath. GAAP EPS was negative 49 cents. Adjusted was negative 45 cents. The street was looking for something closer to what, negative 10 cents?
A huge miss. And the adjusted EBITDA number really tells the tale. A loss of $7 million.
Right, compared to a gain of over $1 million in the same quarter last year. That is an $8 million swing to the negative.
So before we panic, management tied this directly to strategic costs. What exactly were they spending that money on?
So that $7 million loss, about $6.7 million of it was these one-time transformation costs. And you have to think of it as the cost of the pivot.
Okay.
They were winding down their old sales and marketing teams to make way for the Sunkist deal. They had severance, inventory write-offs, all the cleanup costs associated with repositioning assets for sale.
So they were deliberately taking the hit now to clean up the books for later.
Exactly. And the market seems to get it. The stock barely moved after hours. It was down less than 1%.
Which tells you investors are willing to wait and see. They're buying the story, at least for now.
They've been given a hall pass on 25. It's all about what happens in fiscal 26 and beyond.
Okay, so let's unpack that pivot. They're moving away from lemons, promising huge cost savings. How are they cutting costs while also, supposedly, getting better customers? That feels like a contradiction.
It does, but that's the genius of the Sunkist partnership. It's all about fixed costs.
Explain that.
So Limoneira was spending about $1.50 per carton on its own global sales and marketing, just trying to move the fruit. By rejoining the Sunkist co-op, that cost, it just plummets.
To what?
To 60 cents a carton. It's a 60% reduction in a core unit cost right off the bat.
Wow. And they're guiding to what, 4.5 million cartons next year?
Exactly. So that's millions in structural savings baked in before they even sell a single lemon.
And the customer side.
That's the other half of it. Sunkist is, well, they're the big player. They have access to huge U.S. retailers that Limoneira just couldn't crack on its own.
Right.
But here's the real kicker. Sunkist has the exclusive deal with a massive quick service restaurant chain.
For their lemonade program.
For their nationwide fresh lemonade program. That is steady, high volume, high value demand that just takes a ton of volatility out of the equation for them.
Okay, so that's bucket number one. What was the second part of the savings?
Just slimming down internally, they pointed to a 50% reduction in SG&A.
Selling, general, and administrative expenses. For anyone listening, that's basically corporate overhead.
Correct. It's the back office, executive salaries, all that stuff. And a 50% cut translates to another $10 million or so in savings.
So you add the Sunkist deal to the internal cuts, and you can see a clear path to profitability in 26.
You can. But there's one more detail people need to know. The seasonality of the business is about to completely flip.
Oh, right. The CFO mentioned this.
Historically, Q1 and Q4 were their weak quarters. Now, because they have to hold fruit longer for those big Sunkist customers, Q3 and Q4 are expected to be the strong ones.
So if you're building a model on this company, you have to completely invert your assumptions.
You have to, or your numbers will be way off.
So if lemons are becoming the stable, boring part of the business, the growth has to be coming from avocados.
100%. The avocado story is all about a massive increase in capacity that's, it's already in the ground.
What do the numbers look like?
They have about 1,500 acres planted right now, but only about 800 of those are actually mature and producing fruit.
Okay.
They have another 700 acres of young trees that are going to start bearing fruit over the next 3 to 4 years.
Wait, hold on. 700 new acres coming online on top of an 800-acre base?
Yep.
That's nearly 100% increase in their production capacity.
It completely changes the growth profile of the company. And they have a clear target for profitability. They're expecting $12,000 to $14,000 in operating profit per acre.
And that brings us to what I think is the most interesting part of this whole story.
The asset sales.
The plan to delever the balance sheet by, well, selling off parts of the company.
They've already closed on the sale of their Chile ranch for $15 million. That's done.
And next up?
The target is another $40 million by the end of fiscal 26. That's mainly from selling their Windfall Farms vineyard and some other land in Argentina.
But the really unique asset, the one that no one else really has, is the water rights.
Right. This is the hidden value. They're targeting $50 to $70 million in monetization from water through fiscal 27.
Now, water rights are incredibly complex. What makes theirs so valuable?
It's all about seniority. In the western U.S., being first in line for water is everything. Their rights in Arizona are Class 3 Colorado River rights.
Which means?
Think of it like a lifeboat in a drought. Their seat is guaranteed. When cuts are mandated, they hit the lower classes first, like Class 5, which supplies cities like Phoenix and Tucson.
So their water is safe.
Their water is safe. And that scarcity creates an opportunity. It's called a fallowing program.
Where they get paid not to farm.
Exactly. Big water authorities will pay them a premium to leave their water in the river so it can be used for critical urban needs. It's a huge potential source of cash flow that has nothing to do with farming.
And on top of all that, you have the lottery ticket, the Lico Del Mar property.
The ultimate high-risk, high-reward play. It's 221 acres right inside the city of Ventura.
And the valuation jump they're talking about is just, it's breathtaking.
It is. They're talking about it going from maybe $100,000 an acre as farmland to potentially $1 million an acre if they can get it rezoned for development.
A tenfold increase. But that's not a financial problem. That's a political one. Yeah. They have to win a public vote.
Absolutely. It's a massive community and environmental hurdle. It's pure optionality on the balance sheet, not a sure thing.
And all of this has to be viewed against their debt load. What was the number? About $72 million in long-term debt?
Yeah, net debt is just over $70 million, which is a lot for a company in a turnaround.
Which makes the news about their debt covenants probably the most important thing on the whole call.
It might be. The banks gave them an enormous amount of breathing room. They swapped out the old leverage ratio, which is tied to volatile EBITDA, for a capitalization ratio, which is based on the value of their fixed assets on the balance sheet. A much more stable metric for them right now.
That's a huge change. It means a bad quarter won't automatically put them in default.
Even bigger, the banks completely suspended the debt service coverage ratio measurement until the end of fiscal 27.
So they don't even have to prove they can cover their interest payments with cash flow for 2 full years.
It's basically a get-out-of-jail-free card. The banks are betting on the assets, not the near-term operations.
But that flexibility must have come with strings attached.
Oh, for sure. You can bet that any cash from those asset sales, the $40 million from land, the $50 million from water, a huge chunk of that is mandated to go straight to paying down debt.
So the whole thesis really boils down to 4 key catalysts. 1, prove the Sunkist deal works.
2, hit their volume guidance for 26, especially on avocados.
3, deliver on those asset sales, the land, and especially the water.
And 4, use that cash to actually reduce the debt. Show a clear path to a stronger balance sheet.
Okay, that brings us to our final segment. And we have to say it, this is for discussion purposes only, and is absolutely not financial advice.
All right, let's put on the hedge fund hat. The P&L is a mess. The stock is thinly traded. But the balance sheet is hiding an enormous amount of value.
The water, the land.
The $50 to $70 million in senior water rights, the $40 million in near-term land sales, and you've got the Lico Del Mar lottery ticket. Plus, management is already talking about share buybacks if the stock stays this low.
So the trade isn't about waiting for a good earnings report.
No. The catalyst is not earnings. The catalyst is a balance sheet event.
What's trade?
It's a monetization event catalyst play. You go long the common stock, aiming for a 20% pop. At the same time, you buy some cheap, out-of-the-money call options maybe 6 months out.
Why the options?
Because the announcement is what matters. When they announce the sale of Windfall Farms or the first big water deal, that's a $40 or $50 million cash event.
Yeah, that forces the market to re-rate the stock.
Instantly. It changes the whole debt picture overnight and will likely trigger that buyback they've been hinting at. The after-hours reaction to this call tells me the market has not priced in the true value of that Class 3 water. That's the edge.
So to wrap it all up, The big takeaway is that Limonena is trying to become a completely different company.
They are. They're moving from being just a commodity lemon grower to this hybrid model.
You've got the high-growth avocados, the newly efficient lemon business, and then this whole other side of the company that's just about monetizing hard assets.
Right. And for a final provocative thought, look even further out, past this immediate turnaround. Management briefly mentioned a new organic recycling joint venture.
I saw that.
It's expected to add another $4 to $5 million in EBITDA starting in fiscal 27. Think about that. It's a totally new revenue stream, turning farm waste into valuable products. It adds another layer of resilience that has absolutely nothing to do with the price of avocados or lemons. That's the real long-term surprise factor here.